Alright, gang. So, what is good, guys? Um, just came back. I went out, so like literally just came back couple of minutes ago. Very tired, but I was like maybe I should just skip, but I was like, stop being the fucking bitch and nigga, carry your ass up and record. And I'm like, okay, yeah, sure, like let's just do this thing. I've never eaten. Okay, so but yeah, so let's get into what we want to do for today because I'm freaking fucking tired. Also, just got a new haircut, clean, you know. Anyways, so today we'll be talking about liquidity. So sorry, the camera is shaking so much. I'm trying to hold it on my hands right now. Let me see if I can balance this. Okay. So, what is liquidity? Alright, so let's look at what liquidity is. Essentially, liquidity it is like a price point for market where there's enough volume, alright, for the market movers, which is like the banks, to be able to move price in the direction that they want it to go. Okay, so there is liquidity. Um, so there's a particular price point where there's a lot of volatility in the market. Okay, there's a lot of volatility in the market. People are buying and selling at the same time. They're entering at the same time and they're exiting at the same time. Okay, so that is what liquidity is about. So we're going to be explaining it, and we're going to be doing the live the practical examples actually. So I'm going to break it down into part one, two, and three. Okay, so liquidity is essentially, you know, there is a high or there is a low, right? Depending on which one that is there, right? And that high, alright, it is like a point where let's say we are in an uptrend. Okay, essentially I'm supposed to like draw this, but I'll give you guys like the explanation, okay, for now. And then in after the psychology video, the next video, then uh I'll now what's it called, I'll now show you guys on the chart, and then we'll continue the practical examples until we're done with liquidity sweep. Okay, but we're still looking at what liquidity is. So, like I said, it's a price point for where the market movers want to be able to get a lot of orders, that a lot of people to be able to fill in their orders for them to push market in the direction that they want it to go. Okay, so for instance, let's say we're in an uptrend, alright? Normally, okay, uptrend, how is it formed? Lower highs, higher highs, and higher lows, okay? Downtrend is formed by lower highs and lower lows, okay? So uptrend is higher highs and higher lows, alright? So now there's a high that has been formed, okay? And essentially, there are, okay, let's say there's a low that has been formed, or there is a high that has been formed, okay? So let's start with the high first. So the high, okay, people are trying to, this is a high, move up and they move down, right? People are trying to go short from that high, okay? So, which is like definitely, obviously, we obviously know that that's not a smart move, because why? You want to trade with the trend, you want to trade in the direction that trend is going, which in this case is upward. So you want to be looking for buys instead of sells, okay? But there are some people that are, you know, trying to take, they're trying to take shots, right? They're trying to, sorry. Yeah. So these guys, they're trying to take shots from the market, okay? So after they see a high, they take their orders from that high, alright? So their stop loss above the high, because why? That will be the invalidation point for them, okay? So that will be the invalidation point for them, okay? And they're expecting price to go down. So when this they you know they have their position set there, all right, okay, so they are like saying that, okay, let's see where it goes to, and then market start moving down, all right, in their favor, okay. So as market starts to move down, all right, they're happy, they're joyful, they start seeing some maybe little profit, okay. And then when the market forms a low, all right, there are people that are obviously trying to buy, okay. They're trying to buy because why? A low has been formed, so obviously they're trading smart, they're trading with the trend, all right. So they're trying to trade with the trend, okay. So I know what liquidity sweep is, but like it's just like how to be able to pass that knowledge on to you guys so that you can fully understand why we want to use liquidity sweep and how it applies to us, and like the whole concept. So back to what I was saying, people have taken shots from that high, right? And then there are people that are also taking buys from a low that has just been formed. So what does the market do? Essentially, first of all, to take out the people that have set their stop loss, all right, for the sell, all right, that they were taking, which was at the high, that they took it at the high, all right, and then those guys are gone, right? Now the buyers that took their buy from a low are what? They're rejoicing, they're celebrating, they are happy that obviously the market is going in their favor. But all of a sudden, whoops! Oh, remember it has already taken out the people that placed a sell, all right, from their stop loss, and then comes down again. So thereby making the people that placed sell initially correct, all right, but just not at the right time. Okay, which is funny. So essentially, the both buyer the buyers and the sellers got liquidated, and this was like something that I noticed, like when I started trading. I was like, come wait, why is the market behaving funny? Why is it that when I place a buy, at that time I didn't even know what liquidity sweep was. Okay, so when I placed a buy, the market would go in my direction a bit, retrace. Sorry, when I placed a sell, actually, the market would go down in my direction, retrace, like go back, take out my stop loss, and then go back in the direction that I predicted. And I'll be like, what's wrong? Like, what's going on? Why that? Like, it's mostly like a very maybe relatively small move. I will just come and take out the stop loss and go back in the direction that you predicted. Okay, so that was you know that was one part of it. Okay, now let's so later I got to understand that that was liquidity sweep essentially. So now let's talk about when we're going into um when we're going into sales, or when we're going into the opposite direction. So we started with an uptrend to a downtrend, right? And now I want to go from a downtrend to an uptrend. Okay, so how does a downtrend form? Lower high and lower lows. Okay, lower high and lower lows. Good. Now, so let's say a high, right, was formed, or a low. Let's start with a low. A low was formed. Okay, niggas are starting with a low. So lows get formed. Now there are people that are trying to buy in a downtrend, okay, which I said, like previously stated, is not obviously smart. Okay, so you don't want to trade against the trend, you want to trade with the trend. Okay, so now those guys, okay, those guys essentially they're like trading against the trend because, like I said, you are in a downtrend and then you're trading, you're looking for buys instead of sells. How does that play out? You want to think like the market, like I said. You want to think like a casino, okay? You want to think like the casino. You want to trade with the trend. You want to trade with the market. Trade with the system. All right, that's the smart way of thinking, okay? Because how do you expect to make money if you are trading like a normal retail trader? So, back to what I was saying. There's a high, and then a low gets formed, okay? And then from that low, people are taking buys, which is not smart. They take the buy. Market goes in their favor, comes back down, okay, takes out their stop loss, and then from that high that gets formed, remember after when it starts to retrace, it obviously high will be formed because a high consists of a move up and a move down. Okay, so now people are trying to take sells from there. All right, So there are people that there are people that have taken buys, all right, and there are people that have taken sells up here. So both of them are still in the market. Okay, now the market starts to retrace, goes in the favor of the people that took the sell and goes against the people that takes the buy. Okay, takes out the people that are doing that took the buy, all right, takes them out using their stop loss, takes them out, and then starts to retrace, all right, in the favor of the people that placed a sell, all right, because obviously people are placing sells here and people are placing buys here, so like it's going this way and coming down, taking out people that place buy, all right, and then going back up, taking out the people that place sell, making those people that place buy initially to be correct but just not at the right time again. Can you see how the market manipulates? All right, so it liquidated the both of them. The first people that it liquidated were the buyers, which were correct in the bias of the market but not just at the right time, and then the sellers again, which obviously they were not correct. Okay, the move had already ended. Okay, so can you see how we need liquidity now? Because it essentially helps us to know when we combine it with liquidity sweeps, break of structure, and other, you know, and other structures or building blocks that we have, we'll be able to form a strategy to be able to take and know where price is going and be able to trade with the trend and trade like the market. You understand? So that is essentially what liquidity sweeps are about. So in the next video, I'm going to be talking about, you know, I'm going to be talking about liquidity sweeps part 2, and I'm going to show you the I'm going to show you guys the chart, alright, so it will be more clear. Alright, I have to go now. I'll catch you guys in the next one. See you guys later. Thank you for staying tuned. I appreciate you guys. See you guys in the next one. Peace out.